Welcome back to the Deep Dive. Today, our mission is to cut through all the noise around a really consequential earnings call.
We're talking about Palo Alto Networks.
That's right, their fiscal Q1 2026 results for the period ending October 31st, 2025.
And this deep dive is, it's vital, because what we're looking at here is a company at a real strategic inflection point. This after-hours call was less about just reporting strong numbers and more about justifying this massive, expensive, and really aggressive pivot.
Into new areas, right, like identity and observability.
Exactly, and that's the classic tension. You have these fantastic operational wins, but they were almost instantly challenged by investor skepticism.
Skepticism about the M&A.
All about the M&A, the scale, the valuations, everything.
Okay, so let's start with the numbers themselves. When we first cracked open the envelope, the immediate results suggested a classic textbook beat.
Oh, absolutely. They exceeded expectations across every single key guidance metric.
So non-GAAP EPS landed at 93 cents.
Right, which was comfortably ahead of the 89-cent consensus, a solid 4-cent beat.
And what about the top line?
Same story. Revenue came in right at the high end of their own guided range. $2.5 billion reported.
Slightly ahead of what the street was looking for.
Yeah, just ahead of the $2.46 billion consensus.
Yeah.
So you're looking at about, 15.6 to 16% year-over-year growth? Solid.
Solid, as you say, if not totally explosive. But for a foundational player, that's good.
It is. But, the real health check, it comes from the forward-looking commitments.
You mean things like ARR?
Exactly. Their Next-Generation Security, or NGS, annual recurring revenue, that's the critical metric. It grew 29% year over year.
Getting $5.9 billion.
A huge number. That NGS growth is the engine. And if you want more proof of just their durable scale, you look at the backlog.
The RPO.
The remaining performance obligation, yeah. It represents contracted future revenue. It grew 24% year over year to $15.5 billion.
And that's a key signal for investors, isn't it? When RPO is growing faster than current revenue.
It's a huge signal. It tells you the pipeline is healthy, that they're confident in future renewal cycles. And that's what's so fascinating here. You have this immediate disconnect.
The numbers are great, but the stock was muted.
Muted and cautious. The execution was strong, but the market was clearly waiting for clarity on all that strategic risk.
Which is why we need to unpack the execution first.
Yeah.
I mean, they're generating massive amounts of cash, and that's what's funding this M&A spree.
That's the key. This quarter, they weren't just growing, they were expanding margins. Impressively so. And that gets buried under the M&A headlines.
So, non-GAAP operating margin.
It hit 30.2%. That's the second consecutive quarter above 30%.
An increase of 140 basis points year over year.
Right. That operational discipline, it just speaks volumes about the leverage in their model. And we saw it translate directly into cash.
The free cash flow.
Adjusted free cash flow was $1.71 billion, up 17% year over year, which gets you to an adjusted FCF margin of around 69%.
69%. That is best-in-class performance.
It is. It gives them serious financial firepower.
Okay, but here's the critical point for you, the investor, looking at these numbers. Achieving a 30% margin and 69% FCF conversion is impressive.
Sure.
But the Chronosphere deal alone was valued at $3.35 billion. A huge multiple. So how does management convince us they won't just dilute all of that hard-won margin gain?
Well, that's the core tension, and they tried to address it head-on. They're claiming the efficiency gains from their platformization narrative will offset those costs.
The idea that customers are consolidating onto their platform.
Exactly. They noted about 60 new platformization wins this quarter. And this isn't just about selling a few more products. It's about convincing huge clients to retire 3 or 4 niche vendors.
And we can see that in the high-value customer metrics.
You can. They now have 169 customers with over $5 million in NGS ARR. That's up 54% year over year.
And the really big fish.
Even deeper into the enterprise wallet. 55 customers now have over $10 million in NGS ARR. Up 49%. It just shows deeper entrenchment.
And what about the specific segments? SASE, for example.
SASE ARR surpassed $1.3 billion. That's growing 34% year over year in a very competitive space. It confirms their position.
And their SOC platform, Cortex XSIAM, seems to be delivering real results.
Absolutely. XSIAM now serves about 470 customers, with that customer count growing over 150% year over year.
And they gave a tangible security outcome, which you rarely hear.
You don't. Management said over 60% of deployed XSIAM customers cut their mean time to respond, their MTTR, to under 10 minutes.
That's a huge selling point.
A huge selling point for CISOs. And, even their foundational business, their product revenue is transitioning. It grew 23%, and nearly half of that now comes from software form factors.
Okay, so this is where the financial narrative just changes completely. We move from established execution to this incredibly aggressive strategic ambition.
Yeah, the call was just dominated by M&A because management believes we've entered a new era, what they call the AI cycle.
They framed it in almost apocalyptic terms.
They did. They stated starkly that AI attackers are here now. They even cited the first reported case of an AI agent autonomously conducting a large-scale cyber attack.
And that new threat landscape, in their view, means moving beyond fragmented security.
It means owning the foundational data layers, which they define as identity and observability.
And that's the rationale for the two massive acquisitions.
Exactly. First, the surprise, the Chronosphere deal. $3.35 billion in cash and equity.
Valued at a steep, 21 times its ARR?
Roughly, yeah. The price tag is high, but management frames Chronosphere as this essential next-gen observability platform built for the AI era.
They use the term GWAT scale. For the listener at home, what does that actually mean, and why is it worth 21 times ARR?
It's their term for handling immense real-time data ingestion, the kind needed for AI agents. Observability becomes exponentially more complex with autonomous AI.
So the claim is that Chronosphere can handle that scale.
And that it can do it at a third of the cost of leading solutions. If that holds up, it solves a fundamental cost and complexity problem for their customers.
And then there's CyberArk.
The other piece of the puzzle, the pending blockbuster deal. Around $25 billion for identity security.
Which is expected to close in fiscal Q3.
Correct. The vision is to integrate identity from CyberArk and observability from Chronosphere right into their core security data plane. They're arguing you can't have agentic AI security without them.
They also spent time on something that sounds like science fiction. Post-quantum cryptography.
It sounds like it, but it's a very real long-term threat. The belief is that quantum computers will be commercialized by 2029.
And will instantly break all current encryption.
Exactly. But the threat isn't just future decryption. It's harvest now, decrypt later. Adversaries are collecting encrypted data today, knowing they can unlock it in a few years.
And Palo Alto is already rolling out a plan.
Yes, they announced their new 5th-gen firewalls optimized for quantum security. Their new OS, PANW 12.1 Orion, can automatically inventory cryptographic risk. They want to be seen as solving the threats of 2030 today.
So how did all this ambition translate into guidance? Because the market seemed to view the raises as pretty cautious.
I think that's a fair assessment. For Q2, they guided revenue to between $2.57 and $2.59 billion.
So 14 to 15% growth.
Right, with EPS targeted at 93 to 95 cents. The full-year guidance was also just narrowly raised.
It's not a huge jump, considering the price tag of Chronosphere.
It's not. It suggests the benefits aren't expected to be material in the near term, but then you get the real confidence signal.
The long-term goal.
The long-term goal. They raised their NGS ARR target from $15 billion to a truly aggressive $20 billion by fiscal year 2030.
That is a massive statement.
It's the justification for all the valuation risk. They're staking their credibility on it. And they reiterated their commitment to get to a 40% adjusted FCF margin by 2028.
And that's inclusive of the acquisitions.
Explicitly inclusive. They're basically saying, we can do all this, integrate these two massive companies, and still maintain hyper-efficiency.
So let's put it all in context for the investor. We have fundamental beats, a huge long-term outlook, and yet the stock dropped 3 to 6% after hours. Why?
It's that divergence. The sell-off suggests investors are prioritizing the integration risk and specifically that high valuation for Chronosphere.
The 21 times ARR.
That's a steep price. Investors are struggling to justify it immediately. They're demanding proof.
And we have to remember the context of the stock itself.
Oh, absolutely. PANW had rallied something like 23% in the 3 months before the call. It just set an incredibly high expectation bar.
So it was a classic buy the rumor, sell the news.
Precisely. And what's interesting, if you look at the options market, the actual drop was less than the implied move.
Okay, what did that tell you?
It tells you that professional positioning was heavily optimistic going in. The drop wasn't panic, it was just a necessary de-risking event once the M&A risk was on the table.
Okay, let's transition to our final segment. This is not financial advice. Based on this vision, what is the most outrageous but plausible trade idea you see?
Well, the market is mispricing the long-term value of Chronosphere. It's just seeing M&A fatigue.
Okay.
So the idea is a speculative long position on Palo Alto Networks, but you finance it with a short position on a key competitor.
Someone like Zscaler or CrowdStrike.
Exactly.
So why the short position? Why not just go long PANW?
Because the entire premise of the strategy is that the future of AI-driven security simply cannot function affordably without the kind of gigawatt-scale observability that Chronosphere provides.
So the bet is that competitors will be left behind.
The bet is that if PANW is right, then vendors who rely on expensive external data solutions or who just lack this deep integration are going to face massive competitive headwinds in the next 3 to 5 years.
So the 21 times multiple is justified not because it's a great observability platform on its own,
but because it's the non-replicable infrastructure that secures the $20 billion ARR target. It's an AI infrastructure bet. The market is focusing on the check they wrote for $3.35 billion.
and the bet is on the 20 billion ARR destination.
Exactly. The perceived weakness from M&A fatigue is creating, we think, a temporary entry point for the long side of that pair trade.
So to wrap this all up, Palo Alto Networks delivered strong, core fundamental results, backing up their discipline, confirming robust growth.
But at the same time, they committed to this massive, multi-billion-dollar strategic evolution into owning the full security data plane.
Making a bold bet that the long-term AI cycle requires them to move far beyond just firewalls.
Indeed. And considering management's emphasis on real-time visibility against the threat of agentic AI and the danger of harvest now, decrypt later from quantum, the final thought for you is this.
Go on.
Palo Alto Networks is betting the threat is now existential. The real question is whether global enterprises will wait for a Y2K-style crisis or a catastrophic breach before they finally match that sense of urgency.
Thank you for joining us for this deep dive. We encourage you to continue your own research and analysis. We'll talk to you next time.